Hey there, and welcome back to the channel. If you're invested in the stock market right now, chances are you're not having the best time looking at your portfolio. Prices have been falling, everything seems to be in the red, and honestly, investor morale is at rock bottom. But what if I told you that it's exactly in moments like these that the biggest opportunities are born? A crisis doesn't just test your nerves. In the long run, it can actually give your returns a massive boost. In this video, we're going to break down how crises really affect your portfolio, how long these downturns usually last, and why younger investors, in particular, should almost be hoping for a crash. So stick around if you want to learn how to turn market setbacks into real return boosters. If you're invested for the long term, you have to expect these turbulent phases. But that's not nearly as bad as it might feel right now. In fact, it can be a decisive advantage. The finance expert Gerd Karma once said something brilliant. Young people should almost hope for a stock market crisis because over the long term, it works in their favor. Sounds a bit crazy, right? Let's break it down step by step. To understand why a crisis isn't always bad news, let's look at the long-term performance of the stock market. Take the MSCI World Index, one of the most popular global stock indexes. Since 1977, it has grown by an average of 10.2% per year, including reinvested dividends. That sounds incredible, but it's only half the story. That 10.2% is an average over more than 40 years, which included amazing bull runs and brutal crashes. Not a single year delivered exactly that return. Now, let's look at a more recent period, from 1998 to mid-2022. Over these 25 years, the MSCI World delivered an average annual return of 6.7%. Still a solid number, especially when you consider that after inflation, it was about 5.1% in real returns. But here's the key point. That 6.7% is just an average. No investor ever got exactly 6.7% each year. The reality is that the annual results swung wildly. So, what does that mean in practice? Between 1998 and 2022, there were years when the MSCI World returned over 20%, a real party for investors. But there were also 7 losing years, some with double-digit losses, and that's the point. Stock market returns don't move in a straight line. They come in waves, sometimes surging up, sometimes crashing down. Beginners often see a number like 6.7% average return and imagine their money growing steadily, like interest in a savings account. But the stock market just doesn't work that way. In the short term, it's unpredictable, almost random. But over the long term, it follows a clear upward trend. A great book on this is A Random Walk Down Wall Street, which explains why short-term movements seem random, but a reliable growth pattern emerges over time. Now, for the exciting part, how do crises actually affect your wealth if you invest regularly? Let's use an example. Imagine you invested €10,000 every single year since 1998 into the MSCI World. But the journey there would have been a rollercoaster in years like 2001, 2002, or during the financial crisis in 2008. Your entire portfolio would have been deep in the red. In 2008, for instance, your portfolio's value would have dropped from around €160,000 to just under €100,000. Psychologically, that is tough to watch. But here's the hidden advantage. Even during those scary moments, you kept investing your €10,000 each year, but you were buying at much, much cheaper prices. And those low entry points supercharged your returns for years to come. Let's play with this idea. Remember the 2008 financial crisis. The MSCI World plunged about 40%, €160,000. Portfolio suddenly became worth less than €100,000. A nightmare for any investor. But now, imagine that crash didn't happen in 2008, but right at the very beginning of your investment journey in year one. That would mean your first €10,000 investment would instantly drop to €6,000. Painful, for sure. But you would have kept investing every year after that. The result? Instead of €673,000, your portfolio would have grown to €948,000. Why? Because for almost your entire savings period, you were buying stocks on sale. You would have built up about €275,000 more wealth, and your personal return would have jumped from 7.4% to 9.8% per year. The lesson here is that an early crash feels terrible, but in the long run, it can be a massive advantage. This example highlights a crucial concept: the sequence of returns risk. The average return of 6.7% from 1998 to 2022 didn't change in our example. The only thing we changed was the order of the years, and that alone made all the difference. Depending on when the good and bad years happen, your personal outcome can be completely different. So no, it's not irrelevant when crises strike, especially if you're investing through a savings plan. Now, let's flip the scenario. What if the best stock market years happened first and the bad years only hit towards the end? Your portfolio would look like an investor's dream at the start. Okay, one last mind-bending scenario. Imagine all the crises happened right at the very start of your investing career. For 11 straight years, your portfolio would be stuck in the red. You'd keep investing, wondering why on earth you were bothering, since all you saw were losses. But if you held on, the payoff would be astronomical. After 25 years, you wouldn't have €673,000 or even €948,000. You'd have a staggering €2.5 million. Your personal return would be an incredible 16.3% per year. Mathematically, this is the optimal case. But psychologically, it's extremely hard to endure. Who can stick with a plan for over a decade without ever seeing green numbers? So, what's the big takeaway here? The average return is just a theoretical number. It shows what would happen if you invested a lump sum, but most of us invest gradually through a savings plan, and for us, what really matters is the internal rate of return, or IRR, your personal effective return. This is heavily influenced by the sequence of returns. That's why the timing of a crisis makes such a huge difference. So here's our interim conclusion. Crises that happen early in your investing life are actually beneficial. They let you buy more shares for less money. Crises that happen late are far more painful, especially when your portfolio is large and new contributions can't make much of a difference. For younger investors, this means that even if it hurts to see red, early crashes are a gift. The biggest challenge is psychological. Watching your portfolio bleed for years is discouraging, and many people give up right when they should be doubling down. So, how long do these crises actually last? Let's look at the data. The maximum drawdown tells us how far the market fell from its previous high and how long it took to recover. Looking at the MSCI World since 1977, we see 6 major crises that each took over a year to get back to their previous highs. For example, during the dot-com bubble from 2000 to 2003, the market fell 48% and took almost 7 years to fully recover. The 2008 financial crisis saw a 55% drop and took over 6 years to recover. But there were also smaller crises, like the corona crash in 2020. Prices fell 21% but recovered in just 7 months. What does this mean for you? Most downturns last 1 to 2 years on the way down. The recovery can take several years after that. In the worst cases, you might wait 5 to 7 years to see new highs. But that doesn't mean your portfolio is in the red that entire time. During the recovery, prices are already climbing, and the cheap shares you bought are starting to grow. The takeaway is simple. Stock market crises feel awful, but they are temporary. Those who stay patient are usually rewarded. Now, for the most important question. What should you actually do during a crisis? And what should you absolutely avoid? Let's start with the don'ts. First, don't panic sell. If you sell at the bottom, you lock in your losses and you'll miss the recovery. Second, don't stop your savings plans. A crisis is when you get to buy stocks on sale. That's your long-term advantage. And third, don't constantly change your strategy. If you abandon your investment philosophy every time the market dips, you'll destroy the long-term compounding effect. Now, for the do's. First, check your portfolio less often. It sounds simple, but it really helps you stay calm and avoid emotional decisions. Second, review your asset allocation. Maybe you have too much in stocks for your own comfort. If so, adjust it so you can sleep at night. And third, think long-term. Real wealth is built over decades, not in a few boom years. Crises are a powerful reminder that patience is the most important virtue in investing. Of course, let's be clear, crises are never pleasant. Without them, your portfolio would always end up larger. But when they happen, makes all the difference. At the beginning of your investing journey, they can be a blessing in disguise. Your regular contributions still carry weight and help you buy low. But at the end of your savings phase, when your portfolio is huge, crises cause the most damage because new contributions are just a drop in the bucket. This is especially critical if you're close to retirement, which is why you should gradually shift to safer assets as you get older. To sum it all up, crises are an unavoidable part of investing. No one can invest for decades without seeing some red years. But they aren't the end of the world, they're just part of the game. If you're young and investing regularly, a crisis is actually an opportunity. You get to buy cheap, and your wealth grows even stronger over the following decades. The most important rule is to stay in it for the long run. Avoid panic, stick to your strategy, and don't let those red numbers discourage you. In the end, patience is what gets rewarded. And one day, you might even look back and say, that crisis back then was one of the best things that ever happened to my wealth. If you found this video helpful, I'd really appreciate a thumbs up. Let me know in the comments how you're rehandling the current market volatility and what your strategy is. And if you're new here, be sure to subscribe so you don't miss our future videos. Thanks for watching, and I'll see you in the next one.